Welcome back to part two of the Day in West in Retirement series, I guess you can call it. So, next up, we will talk about target date funds. Dun, dun. Lovely new evolution. These did not exist when I started investing. And I remember when they first came out, I was like, what the hell are these things? And they had very high expense ratios when they first came out. They were like 1% fees when they first were developed as a product, but they've come a long way. So here's option two for your 401k retirement option, target date funds. So basically, this chart gives you an idea. What you're buying is a investment uh, vehicle that changes over time. So it basically is putting you in higher risk, higher reward, more volatile assets as you have a longer time frame in retirement. As you start getting towards retirement, they start making transitional adjustments to put you in cash assets that are less volatile and gives you more security. So as you can see, US stocks start tapering, international starts tapering, and as you get closer to retirement, they are increasing your exposure to bonds. Some of these do international, some just do US bonds. Treasuries come into play. Usually treasuries come in after your target date. So before your retirement, it's basically just bonds and stocks is what you're getting. And as you get closer to retirement, they start that transition like a dial starts dialing. And you can go look at various years and see the difference. So as they go like 5 year progressions, usually it's a percentage point or two towards your goal. So that's the easiest way to look at it is these. So you don't do anything. The people running these funds make all these adjustments, set it, forget it. This is the truly one of the few options that you'll never have to touch again. You buy this, and when you get to retirement, you can even keep it after retirement. You don't have to do anything the rest of your investing and working career. If you want a retirement option that you never have to touch, you don't have to learn anything about finance, you don't have to do anything. You just buy this. You never have to think about it twice. This is what you should get. Okay. So here's Charles Schwab. Here's their chart for what they do. Now you'll note there's differences. They're all different. So what Schwab does, Vanguard, Fidelity, they all have different mixes of products. So every target date fund is different. Speaking in 401k terms, you don't have an option. So my option is T Rowe Price. My wife has T Rowe Price. We have no say. That's the target date fund we have in our retirement. If you have options, then that's interesting. I don't know. I would tell you any of them are better than the other. So you could just look at the asset mix and pick the one with the best fee. So this is what you're buying. Like I said, you have at the beginning, it's almost all equity exposure, and then that trickles down as you get closer to retirement, and then they give you more exposure to bonds as you get closer. And then some of them have different mixes of international to U.S. equities. That it's not always the same, but this is just talking about the differences between bonds and stocks. Cash usually doesn't come into play for some of these until you actually hit retirement, where they actually have cash assets. So that's what you're buying. And you can see like here's this is T Rowe. This is like the one that I have an option. You can see like they have all this like growth stock value and then the SP 500. I don't know why these are separated. Large core. So like this is a lot of stuff. Some of them are very simple. The Vanguard one is like 5 holdings. It's simple. I can even you could probably even pull it up here. But yeah, the Vanguard one is like 5 holdings. That's it. And this one, here's Schwab's version. You can see it doesn't because they don't have a total US market or ETF that they're using here. Whereas Vanguard does use the total US. So here they have like this, then they have a small cap separated. Some of them do and don't. It's not really that important, but just to show you. So like here's an example. They're different. Just understand this. The equity allocation, fixed allocations over time are different between all the target date funds. So even if it's the same year, you don't really have a choice though. So in the end, don't worry about it though. The whole point of these funds is not you're not optimizing your return, right? So you're getting a transition from equities to fixed income bond type of exposure as you get closer to retirement. The volatility goes down as you get closer to retirement because you don't want high volatile investments as you get closer to retirement, because if the volatility goes the wrong way, say we go into a recession, 30% drop in the US market, you're exposed to that if all you bought is the S&P 500, and maybe at that point you need to retire. Maybe your health is starting to wane. You have to do your 4%. You have to pull 4% of your retirement fund at the worst time possible. So that's why you need to increase you need to lower your volatility as you get closer to retirement. So this does it for you. You never have to do anything. So here we can look at some of the pros and cons. So we already talked about the pros. It's a set it and forget it. It's a true set it and forget it investment. Where the hell did it go? Okay. So advantages: simplicity of choice. You buy this, you don't think about it. And you can even slightly tweak. Let's say, so 2045 is my retirement fund. If I was to buy one of these, that's the 60 when I turn like 62, close to it. So if I wanted to be more aggressive, if you look at the chart, I could go out further. I could do like a 2050, and that would give me more equity exposure longer. I wouldn't tweak it too much, honestly, because that's not the point of a target date fund. Don't buy the one 20 years after your retirement. Like, don't get that crazy, but you could like do the one 5 years after your retirement date, or 10 years. I wouldn't go past that. If you want to be more conservative, you could buy the one 5 years before your date. So simplicity of choice, that's really the only decision which year. It's something for everyone. It's got all the different asset classes, and it will transition. You don't have to do nothing. Disadvantages: this is what we just talked about. Not all the funds are the same. They're all different. The expenses, typically, pretty much everyone I've looked at, it's a higher expense ratio than if you just bought like the S&P 500 option. So this is a higher expense because they're doing, the firms are doing active, decision making for you. So it is more expensive. So it'll never be the same fee as like an S&P 500 index. So, and then they all do about the same and just in different ways. So the only big problem though is these are, so I'll show you here. Disadvantages here: one size fit all. They're one size fit all. They have no idea who you are, and they don't make decisions on the allocations based on any situation. So I have a pension. I can take more risks because I already have a fixed income that I don't necessarily need to pull. As soon as I retire, I don't have to start pulling from my retirement account. So I can be more aggressive if I choose to, or more conservative. So I have a different decision maybe than you. If maybe you have a 401k with an 8% match, but you have no pension. So these funds don't take those into consideration. So these are one size fit all, and they don't care about your situation. Higher expense ratios, they will probably always be higher expense. These are not optimized products. They are products that get you to the end in one piece, basically. And that's what they're for. It's simple, but the simplicity comes at a higher expense ratio. Not crazy more, but more. Lack of diversity, I don't agree with that. So this is what you could buy. So if you look here, this is my wife's fund, just the options, T. Rowe Price. That's what they've given us. So she doesn't have a choice if she Vanguard or Fidelity. Can't do them. You get just the T. Rowe Price method. Here it is, and I looked it up. It's the expense ratio is like 0.4. So I mean, an S&P 500 could be like 0.04. So you're talking 10 times the expense ratio for something like this. But it's peace of mind, and you'll never have to learn anything about anything related to finance. You just buy this and you hold it, and when you get to retirement, you could still hold it afterwards. You have to make no allocation changes, but that comes at higher expenses. And I would argue it's not like some of the stuff they do, I find kind of weird. So like Schwab's target date fund, this one, I don't understand why they have such a high. I don't agree with this 100%. Don't agree with why they have 6% exposure to US REITs. I don't understand, because you have REIT exposure in some of the other products in here. I don't really care for that. And also, I don't really want bond exposure to this degree yet, even because I have a pension. I'm willing to take on more risk. I don't want bond exposure. Maybe 10 years out from retirement. I feel pretty safe with that. So this is not personalized, like I said. So I'm not really interested in owning this for my situation, but it could be great for you. So just as an example. So This is target date funds. This is another great option for you. All right. I'm not going to say which one, rank them, but we've covered two now. So here's the second option. And next we will cover, was it number three fun boglehead, which is kind of interesting. So we will cover that next. All right. Thanks.